You know what no one really talks about at the dinner table? Where grandma's going to live in 10 years. But let me tell you, Wall Street is thinking about it a lot. Welcome to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas.
And I'm Lana Chen. Today we're diving into Welltower, ticker Well, the largest healthcare REIT in the world. This is episode 135, and the timing could not be better.
It really couldn't. We're sitting at the front edge of what people are calling the silver tsunami. Baby boomers are turning 80 in 2026, and the demand for senior housing is about to go parabolic. Welltower is right in the middle of all of it.
And the numbers backing that up are substantial. But first, let's talk about what this company actually does.
Welltower was founded back in 1970 as Healthcare Fund, rebranded to Welltower in 2015, and today they're headquartered in Toledo, Ohio. They own and operate over 2,500 seniors housing and wellness communities across the U.S., the U.K., and Canada.
What makes them different from a typical landlord REIT is how deeply they're embedded in operations. They don't just collect rent. They run a seniors housing operating portfolio, what they call SHOP, where they're directly involved in day-to-day management alongside operating partners.
So they've got triple net leases on one side, outpatient medical facilities on another, and these direct operating partnerships where they share in the upside. It's a hybrid model that gives them operational leverage most REITs don't have.
And that operational involvement is a key differentiator. They've built a proprietary data science platform, over 15 years of operating data from more than 100 seniors housing operators. That's a training data set no competitor can replicate.
Think of it like this. If you're trying to figure out which senior living community to acquire, most companies are looking at spreadsheets. Welltower is running machine learning models on 15 years of granular operating data. It's a completely different game.
The sector tailwind is real too. Industry occupancy is approaching 90%, but supply remains constrained, with 4 consecutive years of demand outpacing new construction. That pricing power is flowing straight to operators like Welltower.
Now let's talk about the person steering this ship. Shank Mitra has been CEO since October 2020, so about 5.5 years now.
Mitra's background is fascinating. He's got a Columbia MBA in applied value investing and cut his teeth at Millennium Management, Citadel, and Fidelity before coming to Welltower. He rose through the ranks as CIO and COO before taking the top job.
He's known as the data guy. He's the one who championed this whole machine learning platform, and he sits on the board of Public Storage, which tells you the real estate world takes him seriously.
His track record speaks for itself. Under his leadership, Welltower has delivered 13 consecutive quarters of 20% plus same-store NOI growth in the SHOP segment. That's a remarkable run.
All right, Lana, let's get into your favorite part, the numbers.
Gladly. Let's start with valuation. Welltower is trading around $201 a share, with a market cap of roughly $145 billion. That makes it the largest healthcare REIT in the world by a wide margin.
And the PE ratio is going to make some people's eyes pop.
It is. The trailing PE is about 140 times earnings. But here's the thing with REITs, you can't just look at GAAP earnings. The more relevant metric is funds from operations, or FFO. Welltower's normalized FFO was $5.29 per share in 2025, and they're guiding for $6.09 to $6.25 in 2026. That's an 18% jump.
So the headline PE looks scary, but the FFO tells a very different story.
Exactly. On a price to FFO basis, you're looking at roughly 32 to 33 times, which is elevated for the REIT space, but not unreasonable given their growth rate. The price to sales ratio is about 10.5 times on trailing revenue of $10.8 billion.
$10.8 billion in revenue. That's massive for a REIT.
And growing fast. Q4 2025 revenue came in at $3.18 billion, up 36% year over year. Q3 was $2.686 billion, up about 31%. The revenue trajectory here is steep.
What about the bottom line in cash flows?
Operating cash flow was about $2.9 billion on a trailing basis. Free cash flow was actually negative $748 million because they're spending heavily on capital expenditures. That's not unusual for a growth phase REIT, making massive acquisitions.
They've got $5 billion in cash on hand, right?
$5.03 billion, which gives them plenty of runway. Total debt is around $19.2 billion. For a company with a $145 billion market cap and strong FFO coverage, that's manageable. Gross margins sit at about 40%, operating margins at 17.5%, and both are expanding.
And they just bumped the dividend.
10.4% increase. The current yield is about 1.5% at these prices. Not a high-yield play, but the growth in the payout is what income investors should focus on. Overall, Welltower's financial health is solid. The FFO growth engine is firing on all cylinders, but the elevated valuation and negative free cash flow from aggressive acquisitions require monitoring.
So what does Wall Street think about all of this?
The consensus is overwhelmingly bullish. 20 analysts cover well, and 18 of them have it rated a buy. That's 90%. 2 analysts have a hold, 0 sells.
That's about as unanimous as it gets.
The average price target is $231.89, which implies about 15% upside from current levels. The range runs from $205 on the low end to $245 at the top.
Any standout calls?
UBS maintained their buy with a $228 target, citing the strong 2026 guidance. Jefferies bumped their target to $231 from $210 on shop momentum. And Goldman has been vocal about the FFO growth trajectory and how the acquisition pipeline should drive accretion.
The last earnings were interesting too.
Q4 2025 reported February 10th. Revenue of $3.18 billion crushed the consensus estimate of $285 by nearly 12%. EPS technically missed at 14 cents versus the 56-cent estimate, but that's a GAAP accounting quirk. Normalized FFO per share came in at $1.45, up 28% year over year.
And the forward guidance was strong.
Very strong core FFO guidance of $6.09 to $6.25 per share for 2026. They're projecting 350 basis points of occupancy improvement and 4.8% revenue per room growth.
All right, let's lay out the bull case. If you're bullish on Welltower, the thesis starts with demographics.
It has to. 80 million baby boomers are aging into the prime senior living demographic. The 80-plus population is the fastest-growing age cohort in the country, and new supply simply isn't keeping up with demand.
The shop segment is delivering 13 quarters in a row of 20% plus same-store NOI growth. Operating margins expanded 270 basis points just in Q4. That's real operating leverage.
And management has been conservative with their guidance. They're assuming 350 basis points of occupancy gain in 2026, but they delivered 400 basis points in 2025. If the actual trajectory runs hotter, there's meaningful upside to FFO estimates.
Then there's the acquisition pipeline. $5.7 billion in deals closed or under contract in early 2026, including the $3.2 billion Amica transaction. These are supposed to be highly accretive.
Plus, they just hired a new chief technology officer to drive AI integration through what they're calling the Welltower Business System. If that delivers even incremental efficiency gains across 2,500 communities, the impact compounds fast.
Now, for the bear case. Lana, what keeps you up at night on this one?
Integration risk is at the top of the list. They've been on an acquisition tear, $23 billion in transactions, over 1,000 properties acquired in 2025 alone. That's an enormous amount to digest. If execution slips, margins compress.
And they're concentrating the portfolio.
That's a real concern. They're divesting $6.4 billion in outpatient medical properties to go all in on senior housing. That eliminates a defensive income stream. If the senior housing cycle turns, there's no diversification cushion.
The labor situation is still a wild card, too.
Absolutely. Senior housing is labor-intensive. Staffing shortages, wage inflation, and regulatory scrutiny around care standards could all pressure operating margins. The occupancy recovery everyone is counting on assumes you can actually hire enough people to run these communities.
And the dividend payout ratio on GAAP earnings is over 200%.
Right? On a GAAP basis, the payout ratio looks unsustainable at about 211%. Now, REITs are measured on FFO, and the FFO payout ratio is much healthier at around 55%. But if FFO growth stalls for any reason, the dividend growth story gets complicated quickly.
Let's see how Welltower stacks up against the competition. The big three healthcare REITs are Welltower, Ventas, and HealthPeak Properties.
Ventas trades at a similar premium, about 151 times trailing earnings, and they delivered 18.5% revenue growth in 2025. Good, but Welltower's Shopnoy growth is running significantly hotter.
What about HealthPeak?
HealthPeak, ticker DRC, is a very different animal. They're more defensive, with a mix of outpatient medical and life science properties, PE of about 40 times, but revenue growth is only around 2.5%. Much slower lane.
And Omega Healthcare.
Omega focuses on skilled nursing facilities with an $11 billion market cap. Lower growth expectations at about 6% revenue growth, but a higher dividend yield. It's a very different risk-reward profile than Welltower.
So Welltower commands the biggest premium, but it's also delivering the strongest growth.
That's the trade-off. You're paying up for what has been the best execution in the space.
Let's check in on the options market. What's the smart money positioning look like?
The put-call ratio is 1.52, which leans bearish. That means for every call being traded, there are about 1.5 puts. You've got call open interest clustered around the 210, 220, and 230 strikes, and put clusters around 190, 180, and 170.
So there's some hedging going on despite the bullish analyst consensus.
That's typical for a stock that's had a big run and trades at elevated multiples. Options traders are buying protection even though the fundamental story is strong. Implied volatility is moderate, so the premium isn't extreme.
What about insider activity?
It's been quiet on the open market. One notable buy, Director Andrew Gundlach picked up 20,000 shares worth over $3 million. 0 open market sells. The rest of the activity is routine compensation grants and stock plan purchases.
No sells at all. That's a good sign when insiders aren't heading for the exits at these prices.
Agreed. It's not a screaming buy signal, but the absence of selling at all-time highs is quietly bullish.
Let's talk risks and what to keep an eye on going forward.
The biggest risk is execution on this massive acquisition pipeline. $23 billion in deals is transformational, but integration is where value gets created or destroyed. Watch the shop same-store NOI growth number. If it stays above 20%, the thesis is intact.
Interest rates still matter for REITs too.
They do. With $19 billion in debt, every 50 basis points on refinancing costs hits the bottom line. And while Welltower's maturity schedule is well laddered, rising rates compress the spread between their cost of capital and cap rates on acquisitions.
What's the key metric to watch?
FFO per share growth. If they can deliver on that 609 to 625 guidance for 2026, the valuation holds. If they miss, this stock re-rates lower fast, given where multiples sit.
So here's the bottom line on Welltower. You've got the largest healthcare REIT in the world positioned at the front of a generational demographic wave. The shop engine is delivering historic growth, management is respected and data-driven, but you're paying a premium, and the acquisition integration bet is enormous.
The metric to watch is FFO per share. That's the scoreboard for this company. If they can keep compounding at 18%, the stock has room to run. If growth decelerates, the premium unwinds.
And I love this quote to wrap things up. Jesse Jansen, CEO of LifeSpace Communities, said it perfectly. The silver tsunami is here, and now it's time for assisted living and memory care to benefit as boomers turn 80.
It captures the entire thesis in one sentence. Demographics are destiny, and Welltower has positioned itself as the toll road.
That's going to do it for episode 135 of Charged Alpha, the S&P 500 stock encyclopedia. We just went deep on Welltower, ticker WELL. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out.
And remember, past performance doesn't guarantee future results. Always do your own homework.
Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.